Everyone knows the best thing you can do with your money is to invest it, but knowing what to invest in can be very difficult. There are thousands of stocks to choose from, and choosing the ones that go up is not an easy task. But ETFs makes that job a lot easier. What a lot of people don't know is you could just take a couple ETFs and have a perfectly good portfolio. Hello everyone, my name is Jack Murphy, and in this video I'm going to show you how to make the ultimate ETF portfolio. An ETF, or an exchange traded fund, is a type of investment that could be used to track a specific index like the S&P 500 or NASDAQ, or it could be used to track a bunch of stocks in a specific sector or in a similar market, and you can buy them all in one place. Buying an ETF is like buying a basket of stocks or other assets all in one spot. The main benefit of ETFs is it provides diversification. By owning a bunch of different stocks or assets in one place, you're spreading out the risk. If one of the assets in the ETF does poorly, all the others will offset that loss. This means one bad apple in your basket is not going to destroy your whole portfolio. Before you start investing, you want to come up with what your goal is for investing in the first place. Are you investing to have a large lump sum of money when you retire? Or do you want to have more cash flow and be able to retire off of the dividends you receive from your assets? Maybe you have a lot of money now and want to retire quickly, so you want to start getting cash flow from all that money you've saved up. Once you figure that out, it's easier to figure out what ETFs you want to put more of your attention to. Before I go over the ETFs that are in this perfect portfolio, I want to make a disclaimer that I'm not a professional or a financial advisor, and this video is just to give you the ideas of where you want to start your research and the inspiration to do so. The first part of this ETF portfolio, you want a broad market ETF, so you can cover the entire stock market or a large portion of the stock market all in one spot. VTI, or the Vanguard Total Stock Market ETF, is probably the most well-known of this category. ETI is an ETF that tracks the entire market as a whole and has almost 4,000 stocks in it. When you're investing in ETFs, you'll notice they have what's called an expense ratio. ETI has one of 0.03. If you look on the Vanguard website, you can see more details about VTI. And if you go down to the performance and fees, you can see since it was created in 2001, it has had about an annual 8% return, which is pretty good. And in the last 10 years, it has had an 11.6% annual return, which is also very good. The next ETF is another Vanguard ETF, VOO, or the Vanguard S&P 500 ETF. This is an ETF that strictly tracks the S&P 500. The VOO ETF is composed of the top 500 stocks in the market, so this is just the S&P 500, and when people consider how well the market's doing, a lot of the times they go to the S&P 500, so this does track how well the market is performing as a whole through the top 500 companies. If you look at the expense ratio for VOO, you can see it has the same as VTI, and if you look at the performance since inception, of about 2010, you're getting over 13% annually, and if you look at the last 10 years, you're getting over 12% annually. Both ETFs track how the market is doing as a whole, so they have pretty similar results in terms of numbers, so you can't go wrong with picking either one of them. Personally, I'm going with the VOO ETF, which is the S&P 500. I think that since I'm going to be in the market for a very long time, the S&P 500 will outperform VTI just a little bit, in my opinion. I think it's better to have larger compositions of these stronger stocks in the market. But once again, you can't go wrong with either one of them, so take your pick. For the next type of ETF we're going to go with in this perfect portfolio, we want to have a growth ETF. Now this is a type of ETF that is supposed to grow at a faster rate than the broad market ETF like the S&P 500 or VTI. The reason we go with a growth ETF and the broad market ETF and not just the growth ETF is because growth ETFs tend to be more volatile. So for example, if it is going to go up at a faster rate, it has the capability of going down at a faster rate if the market is doing bad that particular year. So you don't want to go all in on a growth ETF, because if you need the money from your investments but the market is down, your growth ETF will probably be a lot lower than you would be with your broad market ETFs incorporated in your portfolio. First option for growth ETFs is VUG, the Vanguard Growth ETF. When Vanguard made this growth ETF, they incorporated a lot of high growth stocks like Apple, Microsoft, and Amazon, and this helps the ETF tend to outperform the S&P 500. On Vanguard's website, you can see the portfolio compositions, and then you can see the sector distributions. So in the sector distributions, you can see that it has nearly half of this ETF in technology, which right now tends to be the highest growing sector in the S&P 500. If you look at the portfolio performance on the Vanguard website, you could see that since it was made in 2004, it's had almost a 10% return annually. Now this is lower than the S&P 500, but you also have to account for that this did go through the 2008 financial crisis, whereas the S&P 500 index was made in 2010 for Vanguard, so it doesn't have that recession in its data. If you look at the last 10 years, it has had over a 13% return in the last 10 years annually, which is higher than the S&P 500 one. The last part of the Vanguard Growth ETF I want to go over is the expense ratio of 0.04. This means I'm paying about $4 for every $10,000 I would have invested in this ETF. Another option for growth ETFs would be Invesco QQQ ETF. The QQQ ETF is pretty similar to the VUG Vanguard Index, but it is just run by a different company, and since inception in 1999, it has had about an 8.6% return annually, and in the last 10 years, it has had nearly a 17.7% return. QQQ has an expense ratio of 0.2, meaning if I were to have $10,000 invested in QQQ, I'd have to pay about $20 in fees. If you go to Invesco's website, you can do some research on QQQ, and if you look in their performance in the last 10 years with an initial investment of $10,000, QQQ would turn into nearly $45,000. And if you look on their website, you could see according to this chart, they've clearly outperformed the S&P 500 and have kept pace with the NASDAQ 100 index. Yes, they have a 0.2 expense ratio, but even with that higher expense ratio, they outperform VUG historically. For that reason, personally, I would go with QQQ in my perfect ETF portfolio because of the historical numbers. But you can't go wrong with either of these ETFs, and they are both solid growth ETFs. The third and final ETF I'm putting in this ultimate portfolio is a dividend ETF. And the first dividend ETF I'm going over is just my favorite ETF in general, SCHD, the Charles Schwab Dividend ETF. So because this is a dividend ETF, I'm going to go over the dividend stats first. First of all, SCHD has a 3.72% dividend rate, which is pretty solid. One of the most important stats is the 5-year dividend growth rate, which is about 15.5%. This is good to see because you want your dividend income to be increasing over time. And lastly, SCHD has been paying dividends for over 10 years consistently. And when you're looking for dividend payers, you want to see consistency. That is the most important thing when you want passive income. Not only is SCHD's dividend stats really great, but their portfolio performance is good as well. Since inception of about 2011, they've had an annual 13% average growth rate, and in the last 10 years, they've had an 11.67 average growth rate, which honestly holds up with the other ETFs we've talked about in a dividend ETF, which is very impressive. On Charles Schwab's website, you can look up SCHD and look at their portfolio holdings, which are all solid dividend companies, diversified pretty well. That is also a positive when it comes to this dividend ETF. SCHD has an expense ratio of 0.06, so if I were to have $10,000 invested in SCHD, I'd have to pay about $6 in fees. If you don't like SCHD, another option you have is another Vanguard ETF, VYM, Vanguard High Yield Dividend ETF. With a dividend yield of 3.11%, they're still very respectable. If you look at their average annual returns since inception, they have about 8%, and if you look at the last 10 years, they have about a 10% average return. VYM has a 0.06 expense ratio, meaning if I were to have $10,000 invested in this ETF, I'd pay about $6 for that. If you look on the Vanguard website, you can look at their portfolio composition, and it's pretty similar to SCHD. If you look at Vanguard's dividend stats, they do have a lower dividend yields, and they only have a 6.6% 5-year dividend growth rate, which is significantly smaller than SCHD. They do have 12 years of dividend growth, which slightly beats out SCHD. I still think SCHD is the better option. So now we have our perfect ETF portfolio, 1/3 VOO, 1/3 QQQ, and 1/3 SCHD. Now, they don't have to be exactly these percentages of each of the ETFs. I'd go with more 30% VOO, 35% QQQ, and 35% SCHD for my personal distributions in this portfolio. A lot of personal factors would go with how you want to compose this portfolio. We go back to what your goals are for investing. If you are young and you want to have a lump sum at the age of retirement, you might more heavily invest into the growth ETF you choose. But let's say you wanted to have more passive income and receive dividend payments from your assets, you might more heavily invest into SCHD and back off from the growth and broad market ETFs. And let's say you just wanted to have less volatility and just hold your money, you might more heavily invest into the broad market and dividend ETFs and stay away from the growth, more volatile ETFs. So that is my ultimate ETF portfolio. If you're interested on a simple investing strategy that anyone can do or common investing mistakes, check out these videos right here. And if that's all, peace.